Good evening once again. So, uh, in our last class, we discussed cost of debts, right? When we started this class about 2 weeks plus ago, I mentioned to you that there are 4 procedures of calculating weighted average cost of capital. So far, so good. We have discussed how to calculate cost of equity, cost of preference share, and in our last class, we dissected cost of debt. So the last step that we are going to discuss will then be the weighted average cost of capital. But before we go to weighted average cost of capital, today we need to talk about cost of convertible securities. So what do you understand by convertible securities? So let's start from there. Yes, for those that are just joining the class, I believe you already have access to the video recording, so you can always watch at your convenience. All right. However, please don't push it, don't defer it to the future. You have to watch the video almost immediately so that you'll be at par with the class. Ordinarily, you are supposed to be ahead of the class. You should be reading ahead of the class. Don't wait until lecturer takes you before you are able to read, because time and time wait for nobody. Before you know it, before you wink, all right, November, here I come. All right. So that's why we are encouraging you to put all efforts into this exam that you want to write. Yearly preparation is key to your passing ICAN exam. All right. So don't wait till the final month or few weeks to the exam before you begin to do crashing. It doesn't work that way. All right. Knowledge is not something you are going to acquire in a day and everything will stick with you. No, it takes gradual for you to memorize things and for the thing to materialize, to sit down in your memory finally. So you need to be refreshing your memory just the way you are putting oil on the engine. All right. So you need to be oiling your brain every now and then so that that thing that you are learning will sit down in your memory. So, but if you learn something new and you abandon it, the thing will also abandon you. Right? Yes, because if you learn something new today now, you don't read it, you don't go through it, maybe a week later or more, that thing will look fresh to you. It will be as if you have not even learned anything at all. So, but it's because you abandon it, and that's why they think abandon you as well. So please, guys, there is no time for you to waste at all. You've already committed your energy into starting this lecture, and you have to give it to it, whatever it will take. All right. You have to sacrifice a lot when you are attending ICAN class. You have to sacrifice a lot. I pray that God Almighty will make it very easy for you. All right then. So, like I said, today our objective is to discuss cost of convertible. Let me write that. Okay. Cost of convertible securities. Then we're also going to discuss weighted average cost of capital. All right. So these are the 2 things we set out to achieve today. Hopefully, of course, we cannot complete this, but we are going. Once we are done with cost of convertible, then I'll be able to introduce you to weighted average cost of capital. The weighted average cost of capital alone will take off for like 2 classes, because I have several examples that we need to test. All right. So ordinarily, it should be just 1 period, but let's see how it goes. Let's see how it goes. Okay, then. So let's talk about convertible securities. Convertible securities. So for those that are just joining us, please, when you want to ask questions, just raise your hand. You are not expected to just talk randomly. All right. So raise your hand, then I will allow you to talk. All right. So, yes, what do you mean by convertible securities? So let's quickly put it there because of time. These are fixed income securities that can be converted to a known number of ordinary shares at a specified future date. Let me put it down. These are fixed income securities. These are fixed income securities, including preference share, bonds, debenture, or loan notes. Loan notes, okay, that can be converted to a known amount of ordinary shares at a specified future date. Okay, so that is what convertible security is talking about or is all about. So it is all the securities are called fixed income security. All right. For example, preference share. The income that preference shareholders will earn from the business is fixed dividend. For bonds, debenture, and loan notes, they are form of traded debts. Okay, they are form of traded debts, and they receive, I mean, the debt holders will receive fixed interest from the business as well. So they are fixed income security. So this kind of security has the future of convertibility. They can be converted to a known number of ordinary shares at a later future date. All right. So that is what convertible security is all about. Then what is cost of convertible securities? Cost of convertible security. Okay. So this represents the compensation attached to the securities that has the feature of convertibility. This represents okay the cost or compensation attached to the securities that has or that have the attributes of convertibility, that have the attributes of convertibility. Okay, so that is what cost of convertible security is concerned. So the cost of convertible security, the cost of convertible security is calculated similar to cost of redeemable preference share or debt. Cost of redeemable preference share or debt. Okay, except that except that conversion value, except that conversion value will replace the redemption value if it is higher. Okay. Now, what I'm trying to say here is that the same way we calculated cost of redeemable preference share or cost of redeemable debt, which of course we are expected to calculate internal rate of return. Okay, let me even put it there, except that. So, therefore, when calculating, therefore, let me put it in a paragraph. Therefore, the cost of convertible securities will be computed as internal rate of return. Okay, the cost of convertible securities will be computed as internal rate of return. When calculating the cost of convertible, when calculating the cost of convertibles, the higher of the following should be selected. The higher of the following should be selected. Okay. 1, conversion value okay, or 2, redemption value. You will recall that when we calculated cost of redeemable preference share or cost of redeemable debt, we calculated present value of fixed dividend. We also calculate present value of redemption value. So that place where you have redemption value, you are going to put either conversion value or redemption value, depending on which one is higher. So if conversion value is higher, that means, of course, you are going to use conversion value. But if redemption value is higher, so of course, redemption value you are going to use. Now, before I tell you what you need to do, let's talk about market value of convertible securities. All right, let's talk about market value of convertible securities. Market value of convertible. Because examiner can ask you to calculate market value of convertible securities. Okay. So just the same way you can normally calculate market value of debt is the same thing. All right. So the market value of convertible represents the present value of future cash flows. Represent the present value of future cash flows What are the future cash flows? E.g., we have the fixed dividends, fixed dividend or fixed interest, and then the conversion value discounted, okay, discounted at the yield, discounted at the rate of return on the convertible, discounted at the yield or rate of return, on the security. Okay, so that's the market value of convertible. Now, this is very important. Note, the investor, we said that convertible securities are fixed income security that have the attribute of convertibility. That is, they are securities like preference share, bonds, loan notes, debentures that can be converted to a known amount of ordinary shares at a specified future date. So you can convert it instead of investors to redeem the preference share or the debt. So they are going to convert it to ordinary shares. That means they want to become part owners of the business. Okay. So now, investor we only convert to ordinary share. Investor, for example, preference shareholders or debt holders, they will only convert to ordinary share capital if and only if it is profitable. That is, if the conversion value is higher than the redemption value, that is only when they are going to convert. Because if conversion value is lower than redemption value, there is no motivation. They won't be encouraged to convert it to ordinary shares. So they will rather wait and allow the security to mature. Then they will redeem it. All right. So it is only when the conversion value is higher than the redemption value, then that means it is profitable. The investor will be encouraged or motivated to convert it to ordinary shares. So I said, note, the investors we only convert to ordinary shares if it is profitable. If it is profitable, that is, if the conversion value is higher than the redemption value, okay, than the redemption value. Otherwise, the investor we just allow the security to mature and redeem it and redeem at the redemption dates or at the maturity dates. Okay, maturity dates. So that's that. So at all time, you have to compare. When you talk about cost of convertible or market value of convertible, you have to compare these two. Okay, you have to compare the conversion value versus the redemption value. So let me bring it at par. What we are trying to say here is that as far as the cost of convertible security is concerned, I said that to calculate cost of convertible securities, simply go ahead and calculate internal rate of return. Whenever you are asked to calculate cost of convertible security, go ahead and calculate internal rate of return. The only difference between cost of convertible and the normal and the redemption value, sorry, and the cost of redeemable preference share or cost of redeemable debt. The only difference is just that instead of you to use the redemption value when you are calculating your NPV, you are going to use the conversion value. You only use the conversion value if conversion value is higher than the redemption value. So if it is redemption value that is higher, that means it is not profitable. The investor will just allow the securities to mature and then they will redeem it at the final day. All right. So at all time, you always need to compare the higher of the conversion value as well as the redemption value. Okay. Then two, we also talk about market value. Then before then, I told you that whenever you want to calculate cost of convertible security, all you need to do is to just go ahead and calculate internal rate of return. How do you do this? You are going to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV, another discount rate will give you a negative NPV. Then when you are calculating your NPV, you need to compare the conversion value with the redemption value. Whichever one that is higher is what we are going to use. So you have a positive NPV, you also have a negative NPV. Whatever the result you have, you go and put it in the internal rate of return formula. That's all you need to do as far as the cost of convertible security is concerned. Then we also talk about market value of convertible. We said that the market value of convertible represents the present value of future cash flows. What are the future cash flows? The future cash flows are just two. If it is convertible preference share, so future cash flow of convertible security preference share is the fixed dividend and the principal repayment, okay? And the principal repayment. So then for debts, okay, for debts, the future cash flow represents the fixed interest as well as the principal repayment. Okay, when you want to repay the principal, of course, you are going to compare the conversion value with the redemption value. Okay, so that's what we have discussed so far. Then finally, I mentioned to you that as far as cost of convertible security is concerned, or as far as convertible security is concerned, investor will only convert to ordinary shares if it is profitable. Okay, if it is not profitable, that is, if the conversion value is greater than the redemption value. If not, the investor will just allow the security to mature and then it will be redeemed at the final date. That's all. So this is basically what convertible security is all about. So at this point, let's have illustration. Let's have illustration. So go to your material. Go to your material. Okay, let me share. Go to your material. Let's have a look. Let me see. Which question is that? Okay, so let's try this illustration number 14 and 15. They relate to cost of convertible security. So let's talk about illustration number 15 first. Singapore Limited. Who is helping us to read? Raise your hand if you want to help us to read. Some of you have not spoken since we started this class. Let me even see. Foluke, my spirit is asking me to ask you to read. Yes. Foluke Adeshina, are you there?
Yes, sir. Good evening, sir.
Okay. Thank you. Good evening. Go ahead.
Yeah, Singapore Limited has 10% convertible debentures with a current market value of
Take it again.
100 and okay.
Take it
Singapore
again.
Limited has 10% convertible debentures with a current market value of 106 naira, and interest payment was made recently. The debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. The shares are expected to have a market value of 3 naira 50 kobo each as at that time. What is the cost of capital to the company for the convertible debentures when company tax rate is 40%, and assume that the tax payment occurs in the same year that the interest payment arises?
Okay, thank you very much. So that is the question. That is the question. So in this particular one, examiner is telling you that you should calculate cost of capital to the company for the convertible debenture. So what are you supposed to do? You want to calculate cost of convertible debenture. Simply go ahead and calculate internal rate of return. All right. First thing first, when you want to calculate internal rate of return, you are expected to assume two discount rates that will produce two opposing NPV. One discount rate will give a positive NPV, another discount rate will give you a negative NPV. Then you put whatever answer you have as your NPV, you put it in the internal rate of return formula. It's as simple as straightforward as that. All right, it's as simple as straightforward as that. So at this point, I will stop sharing this and move to the working notes. That's illustration number 15, page 48. Okay. Solution to illustration 15, page 48. All right. So the name of this company is Singapore. Singapore Limited. We're asked to calculate cost of convertible debenture. I would then say calculating cost of convertible debenture, KD. Okay, let me just give you additional notes. This will be calculated as internal rate of return, okay, by assuming two discount rates that will produce two opposing NPV, that is two different NPV, two opposing NPV, that is a positive NPV and negative NPV. Okay, so once you have that, you now interpolate whatever you have, you calculate your internal rate of return using the IRR formula. Okay, so that's that. So first thing first, we want to assume two discount rates. I would then say assume. You know, in our last class, I told you, under cost of capital, when you want to assume discount rate, I said you should always start from 10%. This is because if 10% is positive, you can increase to 15%. If 10% is negative, you can reduce to 5%. So this will help you to minimize iteration, the trial and error that you are going to do. All right. So, but if you start from 5%, if 5% is positive, you increase to 10% to get negative. If that 10% still give you positive, so you need to increase to 15%. So to minimize that iteration, that's what I suggested, that you should always start from 10%. So we are starting from 10. So we then use this 10% to calculate internal rate of return. So we need two discount rates as well as the two NPVs. So I will create a column for here, description of items, cash flow, discount factor, then present value. Okay. Year 0. I will then go back to the question. How many years do we have in this particular question? Examiner told us that the debenture will be converted to equity shares in 4 years' time. So if this debenture, if the company wants to redeem the debenture, it will be in 4 years' time. That's the redemption date. All right, but the specified future date to convert this debenture into ordinary share capital is in 4 years' time. So our end is 4. So it means that the company will pay annual fixed interest. Year 1, year 2, year 3, up to year 4, the company will pay interest. What's the interest rate? We are given 10% convertible debentures. That's the interest rate that the debenture holders will earn from this investment. So if that is the case, then that's on one side. Also, we also need to get the current market value from the question. What's the current market value? According to the question, the current market value is 106 naira. And we are told that interest payment was made recently. It means that 106 naira is X int price. So if interest expense has not been paid, that means the 106 is cum int price. You don't use cum int price to calculate cost of debt. It has to be X int price. So we are lucky. According to this question, we are told that interest payment was made recently. So that allows us to use the 106 just as it is. We don't need to make any adjustment. So let's go and put it down because of time. So I will then come here, current market value. Okay, current market value is 106. Put it in brackets in year 0. So, oh, sorry, okay, I've given a space here. So we are starting from 10%. So year 1 to 4, the company will pay annual fixed interest. Fixed interest. Okay, I will go back to the question. What's the interest rate given to us? The coupon rate is 10%. Coupon rate and interest rate is the same thing. So coupon rate is 10%. All right. So let's go and put it down. Here will be 10. Now, I purposely put this 10. I want to call your attention to something. We need to go back to the question. If you are given tax rates, you cannot use the interest as given to you. Remember, when we did cost of debt, I told you that debt is always quoted at 100 naira per unit, except if examiner says otherwise. If you are given a different figure other than what you know as the par value, then that's what you are going to use. Usually for bond, at times some federal government bond could be 1,000 naira per unit, it could be 100 naira per unit, but the basic is that it's always at 100 naira per unit. So if examiner wants you to use 1,000 naira per unit, you are going to be given that 1,000. Other than that, it is always at 100 naira per unit. Okay, so yes, what we are saying then is that, of course, the tax rate given to us in this question is 40%. You have to be very careful. You need to go back to the question. Now that you have given me tax rate to be 40%, how am I going to pay the tax? Is tax going to be paid in the current year or in arrears? If tax will be paid in the year profit is earned, that one is fine. That's more straightforward. But if tax will be paid in arrears, you have to consider the gap, 1 year lag. So in this case, if tax is paid in arrears, instead of me to calculate interest from year 1 to 4, to calculate my annuity factor of year 1 to 4, so I will not do that because tax is paid in arrears. I will calculate from year 2 to 5. All right. So I will first of all calculate annuity factor of year 1 to 5. I will now deduct the discount factor of year 1. So that will give me annuity factor of year 2 to 5. All right. So that's what you need to do. But again, is the difference. I mean, the scenario here is different from what I just painted. In this case, we are told that this 40% assume that tax payment occurred in the same year that interest payment arises. So in the same year, there is no 1 year lag. So in that case, I need to calculate annuity factor of year 1 to 4, all right, at 10%. Okay, so quickly, let's go and put the numbers there. Now, this 10%, I cannot use this interest of 10 naira. Remember, I said a tax is quoted at 100 naira per unit. So I don't need to, I can't use 0.10 because it is 10%. No, because if you do 10%, you are still going to multiply with 100 naira per unit. So which will still give you 10 naira. So at all times, to always remove the percentage, just put the number there. Like in this case, the tax rate is 10%, remove the percentage, put 10 there. But what I'm now saying is that this 10, I cannot use it because there is tax in the question. You recall, when we started cost of debt, I said that debt is a cheaper source of financing because of tax benefits. As a result of tax deductibility benefits, the company will pay a lower cost. All right, we pay a lower cost to the debt holders. So let's go and make adjustments. So we do our working. Let's see. I want to space. Okay, that's okay. So working number 1. I want to calculate after tax or post-tax interest. You can call it after tax or post-tax interest. So we need to adjust for tax. So this will then be equal to interest multiplied by 1 minus tax rate. So interest given to us is 10%. Forget about the percentage. All right. Multiply by tax rate given to us is 40%. So 1 minus 0.40. Final answer is 6. So instead of the company to pay 10 naira, okay, per unit of the debenture, to pay 10 naira interest. So they are only going to pay 6 naira. So you can see the cost has reduced because of tax benefits. So I will then come here. Here is 6. Then finally, in year 4, pay attention to this. You will recall that when I was explaining it, I told you that you are going to select the higher of conversion value and then redemption value. So you remember, usually whenever we want to calculate cost of redeemable debt, what do? You then come and you put redemption value, right? So this place where you put the redemption value, you are not going to put it when you want to calculate cost of convertible. You need to first of all calculate the conversion value. You now compare with the redemption value. Whichever of the two that is higher is what will come here. So quickly, let's go through that together. I'm too fast. Kemi. Okay, that's good. Thank you. I will adjust. Okay, so let's go back to working number 2 now. I want to calculate conversion value. Okay, let's do working for conversion value. How are you going to calculate your conversion value? So, instead of the company to, instead of the debenture to be redeemed, all right? Of course, if you want to redeem it, you know that it's at 100 naira. The par value is at 100 naira. If it's at a premium, it will be more than 100 naira. If it's at a discount, it will be less than 100 naira. So this conversion value, we then go back to the question, how are we going to redeem the debenture? Sorry, how are we going to convert the debenture to ordinary shares? So examiner told us that the debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. The shares are expected to have a market value of 3 naira 50 kobo each as at that time. All right, so if that is the case, what are you supposed to do? Let's calculate the conversion value. So examiner has told you that at a rate of 4 shares at 10 naira. So 4 shares, this will be equal to 4 shares multiplied by 10 naira, then multiplied by the market price. The market price is 3 naira 50 kobo. All right. So what do you have here, please? Quickly. Multiply for me. What do you have? 40 naira multiplied by 3.5. This should be, yes, 70 plus 7, that's 140. This is 140 naira. Please confirm for me.
You are correct, sir.
It's correct,
Okay,
sir.
then. So that is the conversion value. Now, in the question, examiner did not tell you how you are going to redeem the debenture. If the company wants to redeem the debenture, so examiner is silent. Let me see. What is this? So you are not told if the company is going to redeem the redemption, I mean the debenture, you are not told how. So it is assumed to be redeemed at par. All right. Where examiner is silent as to how the debenture or how the debt will be redeemed. So it will be assumed that it will be redeemed at par, that is at 100 naira. Therefore, I will then say redemption value equal to 100 naira. That is at par. So, therefore, you need to select the higher of the conversion value and then the redemption value. Select the higher of one conversion value. Conversion value is 140 naira. 2. Redemption value. Redemption value is 100 naira. So this guy is higher. So I will then come here. I will put conversion value, which is 140. So instead of us to redeem this debenture at 100 naira, it should be 140. You can see it is profitable because conversion value is higher than redemption value. So that means the investors will be motivated, the debenture holders will be motivated to convert to ordinary shares. Because if it is not attractive to the investors, they won't convert. They'll just wait till the final day to redeem the debenture. Okay. So a wise student should have gone ahead and give me an annuity factor before I ask you. Give me an annuity factor of year 1 to 4 at 10%.
3.170 approximately.
Thank you. So here is one. Annuity factor. In case you don't know how to calculate annuity factor, let me show you for the last time. Working number 4. Annuity factor. AF. Or you call it cumulative discount factor. You use annuity factor where your cash flow is constant. Like in this case, the interest is fixed at 6 naira for year 1 to 4. So annuity factor equal to 1 plus 1 minus 1 plus r raised to power minus n divided by r. So at 10%, discount rate that we assume, this should be 1 minus 1.10 raised to power minus 4. N is 4 years. All right. Then divided by 0.10. So this will give us 3.170. Okay. So here is 3.170. So discount factor at 10% for year 4 will give us 0.751. Okay. So let me show you the formula for discount factor. All right. Discount factor, let me use it. DF. DF is calculated as 1 plus R raised to power minus N. So in this case, at 10%, at 10% for year 4. So it will be equal to 1.10 raised to power raised to power minus 4. So this will give a 0.751. All right.
No, sorry, sir. It's not 0.751. But I'm getting off.
Sorry,
683.
0.683.
Yes,
Yeah,
sir.
683. Yes. 0.683. You wanted to say something? Who is talking to me? Yes, talk to me, talk to me.
No, I just want to confirm what you said.
Oh, okay. All right, so let's get the present value now. MPV at 10%. So 106 multiplied by 1 will give us 106. 6 multiplied by 3.170. What do you have?
19.02.
19.02.
19.02.
So 19.02, rounding 19. 140 multiplied by 0.683.
96
95.
rounding.
Okay.
90, hold on. Okay, you said 96, right?
Rounding, yes, sir.
Did you say 96?
Yes,
Okay,
sir.
96. So 19 plus 96, that's 115, right?
Yes, sir.
115 minus 106,
9.
that's 9, positive 9, right?
Yes, sir.
Yes.
So we assume 10%. We got a positive NPV. Let's assume a higher discount rate to get a negative NPV. Therefore, we increase to 15%. Somebody should give me an annuity factor of year 1 to 4 at 15%. Yes.
2.8855.
Okay, let me quickly put it down. At 15% equal to 1 minus 1.15 raised to power minus 4 divided by
Over
0.15.
0.15.
So you say it's
855. Oh, yes.
2.855. Okay.
Yes.
Then, please mute. So what's the discount factor at 15%? That is 1.15 raised to power minus 4. 0 what?
572.
572.
Yes, sir. Approximately 572.
Okay then. So here is multiplied by 1. 1 multiplied by 106 will give us 106. Then this one is 2.8. Did you say 855? Let me
855,
confirm.
yes.
Yes, 855. Then this one is
572.
0.572. So let's multiply. 6 multiplied by 2.855. 6
17.
multiplied by 2.17.
17.13.
Okay. That's 17 rounding. Then
Yes.
140 multiplied by 0.572.
80.
80. Okay, 80. 80 plus 17, that's 97. 97 minus 106. That's 9, right?
-9.
Minus 9.
Negative 9. That's it. So at this point, we assumed 10%. We got a positive NPV of 9. We increased to 15%. We got a negative NPV of 9. So at this point, we need to put it in the internal rate of return formula. So I would then say cost of convertible debenture, that is internal rate of return, is calculated as lower discount rate plus net present value of the lower discount rate. divided by net present value of the lower plus net present value of the higher. All of this multiplied by higher minus lower discount rate. So we assume 10 and 15. 10% is lower. So 10 plus NPV of the 10 is 9 divided by NPV of lower plus NPV of higher. This multiplied by higher discount rate of 15 minus lower discount rate of 10. Final answer, what do you have? That's 12.5% because 9 divided by 18 is 50%. 0.5 multiplied by difference between 15 and 10, which is 5. It will give you 2.5. 2.5 plus 10 will give you 12.5.
Correct,
okay.
sir.
So I would then say the cost of convertible security is approximately 13%. All right. Or you can leave it at 12.5%. So that's that. So this is how to calculate cost of convertible security. Whenever you are asked to calculate cost of convertible securities, simply go ahead and calculate internal rate of return. It's as simple as that. All right. So let me know if you have any question before we proceed to show you how to calculate market value. All right, how to calculate market value of convertible. All right. Okay then. So let's go back to the question. Let me stop sharing this. Let me show you how to calculate market value of convertible. Just in case you are asked. Let's go to the illustration. Let's solve this illustration number 14. Lacazette Plc. Who is helping us to read Lacazette? Let me see. David. David, please read for us.
Okay. Lacazette Plc has in issue a convertible debenture with a coupon rate of 12%. Each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. The debenture has 5 years to run. Investor will normally require a rate of return of 8% per annum on the 5 years debt security. Should the investor convert it if the current share price is A4 naira, B5 naira, C6 naira?
Yes, thank you very much, David. That is the question. This particular question does not relate to cost of convertible security. Examiner is only asking you whether investor should convert at the current share price. Should investor convert if the current share price is 4 naira, 5 naira, and 6 naira? What are you supposed to do here? I will come back to that. Let me answer. Kevin, yes, talk to me.
I'm so sorry, sir. I was trying to ask question the other time you asked for that.
Oh, okay. No worries. So,
sir, please explain more on that. The area of tax, the issue of tax. You were saying something
the issue of
arrears
tax.
or yeah.
I said
Maybe
that I said I said earlier that when you are given tax, you want to calculate cost of redeemable debt or cost of convertible debt, and you are given tax, you don't rush. You need to first of all understand from the question, how are you going to pay the tax? Is tax going to be paid in arrears, or in the current year the interest is paid? So you need to know which one. If it is in arrears, that means there will be 1 year lag. Say, for example, let's say we have redeemable or we have this convertible debenture in 5 years' time. This debenture will be converted to ordinary shares in 5 years' time. So I will say year 1 to 5. This is what we are used to. So you have to put the fixed interest. Now, where you have the interest, we said that debt has tax deductibility benefit. All right, so after you have adjusted for tax, you put the value there. Let's say the value in this case is 6 naira. That's the after-tax cost of after-tax interest. So, and you are now told that tax is paid 1 year in arrears. So, if tax is paid in arrears, I cannot use 1 to 5. I cannot calculate annuity factor of year 1 to 5 because tax is paid in arrears, which means that the tax of year 1 will be paid in year 2. The tax of year 2 will be paid in year 3. The tax of year 4 will be paid in year 5. Therefore, then the tax of year 5 will be paid in year 6. So instead of me to do year 1 to 5, I'm going to do year 2 to 6. I need to go and calculate annuity factor of year 2 to 6 because why? Tax is paid 1 year in arrears. So you can only do year 1 to 5 if tax is paid in the current year that the interest is paid. All right. So if tax is paid in the current year, you do year 1 to 5. But if tax is paid in arrears, you are going to have 1 year lag. So instead of you to start from year 1, you are going to start from year 2 because there's 1 year lag. So instead of you to end at year 5, you are going to increase it by 1 more year. All right. So to do this, we are going to calculate annuity factor of year 1 to 6 first. You keep it on one side. You also calculate annuity factor of year. You calculate discount factor of year 1. This is annuity factor of year 1 to 6. You calculate discount factor of year 1 only. So you now find the difference. The difference will give you annuity factor of year 2 to 6. Don't worry, as you proceed, you will see example like this, especially under capital budgeting. You will know more of this. So just to this is just an addition, just to demonstrate to you what you are going to do. Yes, Deji, quickly talk to me.
Sir,
So,
from the question or from the...
Hold on. Kemi,
okay.
Are you fine now?
I'm sorry. Yes, yes.
Okay. Yes, Deji, go ahead.
From the question you just explained now, we just conclude now. I do understand something that in the IRR, internal rate of return. The first one, the A part, is what I don't understand.
You don't
is
understand
it the annuity factor? Is the A representing annuity factor? That's what I want to confirm, sir. Like from the question we just concluded
in
now.
The formula?
Yes.
Are you talking about the formula I gave to you?
Yes.
Hold on. I said cost of convertible debt is equal to A plus NPV of A. Is it this formula you are talking about?
No, sir.
Which one?
Yes, sir. This one, sir. Yes, this one, sir.
I've already told you now. I say A is the lower discount rate. We assume 10%. We also assume 15%. A is the lower. A equal to lower discount rates.
Okay, sir.
B equal to higher discount rates. All right. Is it clear now?
Yes, sir.
So let's solve this question quickly. Now, examiner is asking you here whether investors should convert at the share price of 4 naira, 5 naira, or 6 naira. So what are you supposed to do? Pay attention. In this situation, the most important thing you need to do, you want to know whether they should convert at 4 naira, 5 naira, or 6 naira. Remember, I told you that investor will only convert if it is profitable. For the security to be profitable, the conversion value must be higher than the redemption value. So in this particular question, what you are going to do is that first thing first, you must calculate your redemption value. What's your redemption value? If the company wants to redeem this debenture, at what price? Okay, that will give you the current market value of the debenture. So you now compare with the conversion value at 4 naira, conversion value at 5 naira, conversion value at 6 naira. at any of this price, the conversion value at any of this price that is higher than the current market value, that will be the price at which the investor should convert. All right, so quickly, let's solve this and then we'll move to the next one. Okay. So, solution to illustration 14. I think that's page 40 something. Page 48. All right. So examiner is asking us to calculate or to advise whether the investor should convert at the current market value or at the share price of 4 naira, 5 naira, and then 6 naira. So the name of the company is let me see, Lacazette Plc. So I will come here Lacazette Plc. Okay. Under this situation, or the most important thing to do to solve this question, let me put it this way. To solve this question, okay, the most important thing to do, okay, the most important thing to do is to, number one, you calculate the current market value. Calculate the current market value of the debenture, of the redeemable debenture. Then 2, calculate conversion value. Calculate conversion value at each share price. At each share price of 4 naira, 5 naira, and 6 naira. Then step 3, select or advise whether, or advise the price, advise on the price at which the debenture should be converted. Okay, that's what you need to do. So that is any price that is higher than the redemption value. So the first step, we said we should calculate the current market value of the debenture. So I would then say calculating current market value of the redeemable debenture. So if the company wants to redeem this debenture in 4 years' time, is it 4 years or 5 years? So at what price? You will recall when we did cost of debt, I mentioned that market value of debt, market value of redeemable debenture or of redeemable debt is calculated as the present value of future cash flows. The future cash flows include both the fixed interest as well as the principal repayments, all right, that is the redemption value, discounted at the yield or rate of return on the debt. So you can call it yield, yield to maturity, or internal rate of return, or rate of return. Okay, rate of return on the debt. So whenever you want to calculate the market value of redeemable debt, or yes, or of redeemable debts, two things. The same way you usually calculate NPV, that's the same way you are going to calculate the market value of redeemable debt. The only thing is that you are not going to include year zero. Okay, you will not, because once you include year zero, it means that you are calculating internal rate of return. So you are calculating NPV. So in this case, I will create a column for year, description of items, cash flow, all right, discount factor. So according to the question, what's the yield? What's the rate of return on this security? Give it to me.
12%.
Rate of return, not interest. There's difference
8%.
between interest rate and rate of return.
8%.
8%.
8%.
Investor will normally require a rate of return of 8%. So I will then come here. Here is 8%. Present value. I told you that the market value of redeemable debts represent the present value of future cash flows. This is the present value we want to calculate. All right. So I would then say year 1 to 4. The maturity date of this debenture is what? We are told 5 years. The debenture has 5 years to run, so it's not 4. So this will be year 1 to 5. Okay. Then finally, in year 5, the company will redeem the debenture. So here is fixed interest. Here is redemption value. Okay. So according to the question, what's the coupon rate given to us? What's the interest rate of the
12%.
debenture?
12%.
12%. Okay, 12%. So here will be, in this question, we are not given tax. So since you are not given tax, so you are going to use the 12 like that. But if you are given tax, you need to adjust for tax. So here will be 12. All right. Don't go and be writing 0.12 because the debt is always quoted at 100 naira. In fact, examiner even put 100 naira there, but we don't need it. So it's implied. So if the company wants to redeem it, it will be at par, which is 100 naira. So somebody should give me annuity factor of year 1 to 5 at 8%. What do you have?
0.304.
That's discount factor, 0.384. Annuity factor, 1 minus, open a bracket, 1 plus 8% raised to power minus 5, then everything divided by 0.08. So what do you have as annuity factor? Yes. Who is giving
3.99.
me, pardon?
3.99.
3 points. Give me 3 decimal place.
993.
3993. Okay. I assume that is correct. Okay. So let's multiply.
I'm not getting 3.99.
So you know the formula now. I showed you the formula earlier on. This is the formula we used there. The same formula we used before. So try it again on your own. So 12 multiplied by 3.993. What do you have? Yes. Let me use my calculator. You guys are slowing me down.
7.916.
What did you say it is?
47.916 or 9.
Okay. That's 48, rounding.
All right, sir.
48.
Yes.
So here will be 30, here will be 38. All right. Are you sure this is correct?
The discount
Let's
factor is
confirm.
wrong. Discount factor is
Uh,
wrong.
discount factor. What's the discount factor? Give it to me.
0.681.
681. 0.681 multiplied by.
So even their native factor is wrong.
Okay, let me confirm from my
It's
end.
correct, sir.
So let me even confirm 1.08. Okay, sorry, 1.08 raised to power 5 minus equal minus 1 equal divided by 0.08 equal 3.9927 is correct. So here will be 68. That's it. This is how to calculate the market value. Okay. So add everything together. That will give us 116 naira per unit of the debenture. So if the company wants to redeem this debenture, this is market value, or you call it, whether you call it market value or present value is the same thing, 116. So if the company wants to redeem the debenture in 5 years' time, the market price will be 116 naira per unit of the debenture. So you need to compare this with the conversion value at each price. So I would then say conversion value, calculating conversion value. Okay. So to get the conversion value, what do? You multiply the number of shares that you want to convert. Number of shares multiplied by the share price will give you the conversion value. So here will be number of shares. Here will be share price. Here will be conversion value. Okay. So we want to convert 20 shares at 4 naira, 5 naira, then 6 naira. 4 multiplied by 20 will give us 80 naira. 20 multiplied by 5 will give us 100 naira. 20 multiplied by 6 will give us 120. So examiner is asking you, at what price should they convert the debenture to ordinary shares? Of course, I told you that investor will only convert if it is profitable. At 4 naira, conversion value is 80 naira. So the investor will not be motivated because 80 naira conversion value is less than the current market value of 116 naira. So investor, the debenture holder will just wait till the final year to redeem the debenture. Also, at share price of 5 naira, investor will not be motivated because 100 naira, the conversion value of 100 naira is less than the current market value of 116 naira. So there's no motivation to convert because it is not profitable. But at 6 naira share price, the conversion value is 120. 120 is higher than the current value of 116 naira. Therefore, the investor should convert at 6 naira. Okay, let's put it down. The investor should not convert, sorry, let me rewrite that, should not convert at 4
One.
naira or at share price of 4 naira and 5 naira, because the conversion value at these prices is lower. Let me write it. Is lower than the current market value of 116 naira. However, since the conversion value at share price of 6 naira since the conversion value, let me put it down properly. Since the conversion value of 120 naira at the share price of 6 naira is higher than the current Deji, why are you speaking in tongue? So you don't enter spirit, don't enter you. Exam never reach you. You don't speak in tongue.
Mr. Juwon, this is blah blah.
Ọlọ́run ṣàánú. He's doing you why. Okay, let's
This
move
is
on.
serious why.
No worries. Higher than the current market value of 116. I said, however, since the conversion value of 120 naira at the share price of 6 naira is higher than the current market value of 16 naira, the investor should convert at 6 naira. Okay, because it is profitable. Because it is profitable at that price. Okay, that's it. That's the end of the question. That's the end of the question. So at this point, so that's that as per convertible. We have done cost of convertible security, then how to calculate market value. Yes, David, talk to me. David, go
Yes,
ahead.
please, I want you to explain again the difference between the yield and then the coupon rate, the cost of capital. Like I know their coupon every year, maybe twice a year. And then the question is also saying that investors will also require that yield every year. What does it mean?
There is difference between when you talk about coupon, okay? Coupon rates is the same thing as interest rates. All right? Coupon rates is the same thing as interest rates. If you can say coupon payments means interest payments. All right? Or is different from the yield. The yield is the same thing as internal rate of return, or you call it rate of return on the debenture. All right? So when you talk about the yield, you can call it yield. Okay, you can call it yield, or yield to maturity. Yield to maturity, or you call it internal rate of return, or you call it rate of return on the debt. All right. So this one is more like a cost. All right. The coupon rate is more like a cost. This one is what the company, what the debenture holders or the debt holders will earn. It's something they are going to earn. So just like when you say you invest, you are return on investments, or you return on capital employed. All right. So the yield is similar to that, similar to your return on capital employed. But under debt, it's not called return on capital employed or something, but it is called yield to maturity or internal rate of return. Or simply put, just call it rate of return on the security, on the debt. So there is difference between interest rates and the rate of return. Are we together? So the rate of return is what the investor will earn on their investments. So this interest rate is what the company is paying to the debt holders. So David, is it clear?
Yeah, I think so. Yes.
All right then. Kemi, go ahead.
Question is similar to that. I still don't get it. Does that rate of returns or the yield mean the same thing as the cost of capital? Because you said the interest rate is what the debt holders, the investors will earn, and which also means a cost to the company. So, what is this rate of return? What does it imply to the company? And does that rate of return mean the same thing as cost of the capital? Because I know they will also pay that coupon
The
rate,
rate
which
of
is
return, hold on. If you don't call it rate of return, you call it internal rate of return, yield to maturity, or simply put yield. You can also call it cost of debt. Are we together? You can call it cost of debt. If you look at the last question that we solved sometime last week, I mentioned to you that the market value of debt is calculated as the present value of future cash flow. What are the future cash flows? The fixed interest and the principal repayment discounted at the yield or rate of return or cost of debt. So it's the same thing. You recall that when we calculated cost of debt, we said KD is equal to the fixed interest divided by fixed interest divided by X int price. You remember this formula, right? So this denominator is the market value. This KD, this cost of debt, is the same thing as rate of return. You can call it rate of return. Okay, you can call it rate of return, internal rate of return, yield to maturity, or simply put, yield is the same thing. So this one is different from interest. Look at the interest there. Look at the interest there. So it's not the same thing. The cost of debt as well as the rate of return, internal rate of return, yield to maturity, they are the same. Is it clear now, Kemi?
yes, sir.
Okay then. David, you raise hand again. Go ahead.
Yes, sir. Okay. So the cost of capital, that's the interest rate, is clear since the company will be paying the coupon to the creditors.
Interest rate is not cost of capital. Interest rate is not the same thing as cost of capital. Don't mix it. I told you that interest rate is the same thing as coupon rates. It's not cost of interest rate is not cost of capital. Cost of capital is what we have just demonstrated to you. This is your KD, that's your cost of capital. The cost that the company will pay to the debt holders, that's the cost of capital. It's a compensation. It's a return on their investment. It's a return on the investment of the share of the debt holders. So it's not the same thing as interest rates. So don't mix it together. All right?
Hello, sir. Please, I have a question. Oh, sorry for dragging you back.
Who is speaking? Who is speaking?
This is Emeka.
Okay, go ahead. I said you should always raise your hand.
I'm sorry, sir.
Go ahead.
Please,
It's okay.
in
No
the
worries.
first example, when we were solving our answers in Singapore Limited, we started with year 0.
Yeah.
In our next example,
Yes.
we didn't use years. We didn't start with year 0. I wanted to know the reason why.
I've already, this is what I explained to you. I said that when you want to calculate, look at, this is what you are saying, Abi. Emeka.
Yes, sir. Yes, sir.
Emeka. So you can see here that what you are calculating is different from the two, what we calculated in the two examples are different. In this question of Singapore, you want to calculate net present value. Look at here. You are calculating net present value. In the second one, we are calculating present value or market value. So here we are calculating market value. Look at, so it's not the same thing. I mentioned to you that when you are calculating NPV, of course, year 0 will be there. Then you calculate the present value of interest, present value of redemption value. So you get your NPV. However, whenever you want to calculate market value, I told you specifically that you don't include year 0 because look at the definition I gave to you as market value. I said market value represents the present value of future cash flow discounted at the discounted at the yield or rate of return on debt. So the present value, the future cash flow represents both the interest as well as the principal repayment. So you don't, whenever you want to calculate market value or present value, you don't include year 0. For redeemables, you don't include year 0 because once you include year 0, you are calculating NPV. Is it clear now, Emeka?
Okay, sir. Thank you very much.
You're welcome. So let's move to WACC. Let's move to WACC. We have spent too much time on this convertible. So let's talk about weighted average cost of capital. Calculating, or let me just put it here first. Weighted average cost of capital. Okay. WACC. So I explained to you, I also reminded you earlier today. So far, I've demonstrated how to calculate cost of equity, cost of preference share, cost of debt, and we just finished cost of convertible securities. All right. So the final areas we are going to touch under traditional WACC is how to calculate the WACC itself. All right. So I've already explained to you when we started on the first day of our lecture that WACC is computed, traditional WACC is computed when information on capital structure, including their costs, are given to you. If in a question you can see ordinary share capital, you can see preference share capital, you can see debt capital, including their cost. The cost associated with ordinary share capital is ordinary dividend. Okay, the cost associated with preference share capital is fixed dividend. The cost associated with debt is given as interest. So if in the question you are given information on on ordinary share capital, preference share capital, and debt capital, you need nobody to tell you that you are supposed to calculate traditional WACC. All right, you are going to calculate traditional WACC. And how to calculate the traditional WACC is what we have been discussing for almost 3 weeks now. All right. So if that is the case, what is even WACC? What is WACC? Let me put it down for you. Okay. What is WACC? WACC represents the minimum or the overall cost of capital for a firm. Okay, this represents the overall cost of capital for a firm. Okay, it is computed as the average. Okay, it is computed as average. I would love if I can solve one question under this WACC today, so that subsequently, if I can do additional 2, that will be fine. So it is computed as the average cost of individual source of finance. It is computed as the average cost of individual source of finance or source of capital, weighted according to the proportion. Okay, weighted according to the proportion of capital okay, let me put it according to the proportion of each source in the source of what? Source of capital in the company total pool of funds. Okay, so that is weighted average cost of capital. You know, we started from cost of equity, cost of preference share, cost of debt. Each source of long-term financing has its own underlying cost. All right, so the average of those costs of source of finance is simply what the WACC is talking about. So let me say, for example, we have ordinary share capital. Ordinary share capital, say, is 1,000. We have preference share capital, let's say 200 million. Okay, then we have debts, let's say 300. When you add everything together, that's 1,500, that's 1.5 billion. All right, so this is the total pool of capital. This is total pool of capital in the company's capital structure. Now, we now say that, of course, the ordinary share capital has its own underlying cost. The cost of ordinary share capital is what we call cost of equity. Okay? Cost of preference share, KP. Cost of debt is the KD. So, when you now want to calculate WACC, you are supposed to weight the cost of individual source of finance according to the proportion of each source of finance in the company's total pool of capital. The company's total pool of capital is 1,500. Let's say, for example, cost of equity is equal to 15%. Cost of preference share is 10% for simplicity. Then cost of debt is, say, is 12%. So we say that the weighted average cost of capital is the overall cost of, I can't just sum all of this together to say 37%. It doesn't work that way. All right, so you are supposed to weight it. How do you weight this cost? You are going to weight it according to the source of finance in the company's total pool of capital. For example, for ordinary share capital, okay, for ordinary share capital, which is E, preference share capital is P, debt capital is D. So if I want to calculate WACC based on these hypothetical figures I gave to you, of course, there is a formula you are supposed to use. But what I want to do, what I want to show you is that, of course, the total value is 1,500. So I want to wait. I want to get the proportion. So that's why we are weighting it. I want to get the proportion of equity. What is the proportion of preference share? What's the proportion of debt? So for me to get the proportion of equity, I will say 1,000 divided by total capital of 1,500. Proportion of preference share is 200 divided by 1,500. Proportion of debt is 300 divided by 1,500. So once I get the proportion of each source of finance, I will multiply with the cost of capital of each source of finance. So for equity now, I will say multiply by 15%. For preference share, multiply by 10%. For debt, multiply by 12%. I will then add everything together. That will give me the WACC. So that's why in the definition here, I said that this represents the overall cost of capital to a firm. It's not that you are going to be adding the cost of individual source of finance. No, you need to weight each of them. You weight it. You get the proportion. So it is computed as the average cost of individual source of finance. This is cost of individual finance weighted according to the proportion. What is the proportion of equity? That is 1,000 divided by 1,500. What is the proportion of preference share? 200 divided by 1,500. What's the proportion of debt? 300 multiplied by 1,500. So once you get the proportion, you then multiply with the cost of individual. It will give you, add everything together, it will give you the weight. So this is just an explanation. That is not where we are going. Now, I've demonstrated, or I've given you the meaning of weighted average cost of capital. So how do you then calculate the WACC? How do you calculate WACC? So come here, calculating weighted average cost of capital. There are two methods of calculating WACC. You can either use market value or you use book value. All right, in most cases, you are expected to use market value. Let me put it down. WACC can be calculated using either market value or book value. Let me write it out in full. Market value or book value. Okay, those are the two methods. So of course, when you talk about market value, let me write it down. Market value method. This should be used always. This should be used to calculate WACC, except examiner says otherwise. All right. At all time, you have to use the market value to calculate the cost, to calculate weighted average cost of capital. Of course, market value is the price determined by the market forces of demand and supply. So that is more realistic relative to the book value. The book value is the value you have in the balance sheet. Okay, like I explained to you in some of our previous classes, I said book value is the same thing as face value, nominal value. All right. So the value you have in your balance sheet, that's the book value. So that particular value does not take into consideration the prevailing market condition. All right. So the markets, the price that is determined by the forces of demand and supply is the market price. Okay, is the share price. All right. So that is more realistic. So At all time, you have to use the market value to calculate your WACC. But if examiner wants you to use book value, you are going to be told. But where examiner is silent, it is assumed that you calculate your WACC using market value. Okay. Now, let's talk about the book value before I show you how to calculate market value of equity, market value of debt, market value of preference share. Or let me even do that once and for all. All right. Okay. The market value of individual source of financing, individual source of capital can be calculated as follows. Okay. So if you want to calculate market value of equity, let's start with market value of equity. Market value of equity. This is denoted as E. All right. So market value of equity, I will give you two different formulas depending on the information available. Market value of equity is calculated as number of shares multiplied by XDIV, share price. Okay, so whenever you want to calculate total market value of equity, this is the formula you are expected to use. At times, examiner may not give to you number of shares. You may be given share capital. So how do you convert share capital to number of shares? All right, so let me show you. Or you can say equity value equal to share capital divided by nominal value. So this, when you do this, it will give you number of shares. Then you multiply with XDIV, X dividend, share price. So these are the two formulas that you can use to calculate market value of equity. This formula is the same thing you are going to use for preference share. All right. So second one, market value of preference share. Okay, denoted as P. So P equal to number of shares. This relates to preference share. The first one relates to equity or ordinary shares. So this one is preference share. Number of shares multiplied by XDIV, share price. Or you say P equal to share capital. This share capital is the balance sheet value, is the book value. Is the amount you have in the balance sheet divided by nominal value. You remember when we did cost of preference share, I told you that the nominal value of preference share is always 1 naira. It's always quoted at 1 naira. All right. So that 1 naira is the par value. If it's below 1 naira, that means it's at a discount. If it is more than 1 naira, that means it's at a premium. So multiply by X div share price. You will notice that the formulas are the same with equity, but here we are talking about equity, here we are talking about preference share. Okay, then the last one is market value of debt. Market value of debt, which is denoted as D. All right, so market value of debt is calculated as nominal value. Again, this nominal value is the balance sheet value. Nominal value multiplied by X int price. All those concept of cum int, x int, cum div, x div, they also apply here. That's why you can see I'm using x int, I'm using x div, so that you don't forget. If you know that if dividend has not been paid, you cannot use that one to calculate cost of equity. You can't use it to calculate market value. So if interest has not been paid, it means that that's the price given to you, the market price given to you is a cum int price. So you need to convert it to x int price. So of course you divide this one by 100 naira. Debt is always quoted at 100 naira per unit. Okay, that 100 naira is constant, but debt is quoted at 100 naira per unit. So these are the formulas for calculating market value of individual source of finance, market value of equity, market value of preference share, the market value of debt. These are the formulas you are expected to use to calculate. Now, let's talk about book value. Okay, let's talk about book value before I give you the formula for calculating WACC. Book value. Book value method. Now, examiner will rarely ask you to calculate WACC using book value. Like I said, the book value is the value in the balance sheet. That's your nominal value. All right. The amount you have in your balance sheet, that's the book value. So that's not realistic. It doesn't take into consideration the market condition. So as a result, investors do not, recognize book value. Okay. Now, when book value is used to compute weighted average cost of capital, let me put it down. When calculating weighted average cost of capital using book value. Okay, using book value, comma, ordinary share capital. Let me write that. Ordinary share capital and reserves should be added together. Should be added to form the proportion. To form the proportion. Proportion is the same thing as percentage or weight. To form the proportion of equity in the company's total pool of capital. Okay. So whenever you want to calculate weighted average cost of capital using the book value, you are expected to add ordinary share capital plus reserve to form the proportion of equity. Let me give you an example of this. Say, for example, you have ordinary share capital. You are also given reserves. You have preference shares. Capital. You are given, let's say, debts. I don't want to call it bond or debenture. Okay. Let's say ordinary share capital given is 1,000. Okay. Let's say we have, let me call it, let's make this one to be 800 for simplicity. Let's say you have reserve of 200, preference share of 200. We have debts of 300. When you add everything together, the total capital, total pool of capital, okay, total is equal to 1,500. Okay, so if you want to calculate cost of equity using the book value, you are expected to add equity, ordinary share capital, and reserve you are supposed to add ordinary share capital as well as a reserve to form the proportion of equity. So in this case, if I want to get the proportion of equity, equity will be equal to ordinary share capital plus reserves, which is equal to 800 plus 200. All right. If I want to get the proportion of equity, okay, let me put it this way, percentage of equity. Percentage of equity. So it will be ordinary share capital plus reserve plus total capital plus total. So in this case, divided by 1,500. So here will be 1,000 divided by 1.5. Okay, so that will give me the percentage of equity. The percentage of preference share will then be equal to 200, all right, divided by 1,500. The proportion of debt, which is D, will be equal to 300 divided by 1.5. Okay, so that is basically that. What we are saying here is that the essence of all of this notation or hypothetical figures is to demonstrate that when you are using book value, you are expected to add together ordinary share capital with the reserve. So you had ordinary share capital plus reserve to form the proportion of equity. All right. So that will give the weight of equity when you are calculating the WACC. So that is the difference between the two. Now, this book value, you are using the amount, the figures you have in the balance sheet. That's the book value. But the market value, in most cases, you are the one that will determine the market value. So using any of these formulas, all right, depending on whether you are calculating market value of equity, market value of preference share, or market value of debt, whichever one, you already have the formula. So the next thing we are going to do under WACC is to show you how to calculate weighted average cost of capital. Okay. WACC. Estimating WACC. Let me rewrite that. What's wrong with you? Okay, estimating weighted average cost of capital, of course, denoted as KW. Now, whenever you want to calculate WACC, there are two ways you can do that. You can either use tabular, or you can either use tabular, or you use algebraic, or you use formula. Whichever one you use, you get the same answer. If I want to use formula, let's say, for example, you have the three sources of long-term financing: ordinary share capital, preference share capital, and debt capital. So in that case, my WACC, denoted as KW, will be computed. Remember, I told you earlier today that WACC represents the average cost. Okay, average cost, weighted according to the proportion of each source of finance in the company's total pool of capital. So if that is the case, I want to calculate WACC. If in the question you are given ordinary share capital, then I will pick the value of preference share. This E could be market value or book value. So depending on what examiner wants you to use. So I will then divide this one with the total value. Total value is value of equity plus value of preference share plus value of debt multiplied by cost of equity plus value of preference share divided by total value, E, equity plus preference plus debt, all multiplied by cost of preference share. All right. So this cost of preference, all those things we'll be discussing from day one. All those things like cum div, ex div, growth rates, where there's growth, no growth, all those kind of stuff you have to apply before you get your all this cost of equity, cost of preference share. All right. So that's why we have to start all those little things, they matters before you get to this point. Then lastly, you need to include debt. All right. So which is equity plus preference plus debt. Whatever you are going to use here must be after tax cost of debt. Your KD you must adjust for tax, 1 minus tax. Students, you don't even respect your lecturer's privacy. You are calling me to 11. I shall know. Eh? Oh yeah, multiply by 1 minus 10. All right. So that is the formula. E is, let me put it down, where E equal to equity value, P equal to preference share, value of preference share, then D equal to debt value. All right. Of course, you already know KE equal to cost of equity. KP, cost of preference share. Then KD equal to cost of debt. All right. So that's that. I think, please remind me, in our last class, did you talk about types of debts, the traded, non-traded debts? Did you talk about it? I think we did.
Yes, sir.
Yes,
Thank you
sir.
very much. Yeah.
We did that.
All right, thank you. So this is, in most cases, or in some instances, this middle guy will not be there. Preference share will not be there. In most cases, it will be between equity and debt. All right, it will be between equity and, but if you have the three of them, so this is how you are going to do it. But if there is no preference share, then you remove the middle one. So it will be between equity as well as the debt. All right, you combine the two. So that is as per that. So using formula to calculate weighted average cost of capital, this is how you are supposed to do it. Now, if I don't want to use formula, I can use table to get the same thing. So using table, I will create a column for the types of security. In this case, I can have equity, I can have preference share. Let me rewrite it. Preference share, I can have the debts. So now the next thing I will do is to get the value. This value could be market value or book value. Here is total. Then the cost of individual capital. So we call it proportion. The cost of individual capital that we have calculated, the cost of equity, the cost of preference share, the cost of debt. All right. So we put it there in percentage. All right. Then we have hash total. The hash total is just like a weight. So you multiply the value with the proportion, whatever it is, put it here. Put it here. put it, then you add everything together. And then you calculate your WACC. So WACC, denoted as KW, will then be equal to hash total divided by total value. Okay, divided by total value, multiplied by 100/1. So whether you use the formula or you use the tabular method, you get the same answer. So when we have live question, I will test it. Let me even see if we can solve only one question today. All right. So this is basically how to calculate weighted average cost of capital. All right. So all the examples that we have solved so far, that is, I mentioned to you, those are not the kind of questions you are going to see on the day of your exams. So the essence of those questions is to test the principle, is to drive the points. That's why we use all those short examples to explain it. So that is not the kind of question you are going to see on the day of your exams. So at this point, let's have illustration. Okay. Suraju is asking, please, sir, what if we are told to use market value method and we are given reserve? Of course, if you have to use market value, you don't include reserve when you are calculating proportion of equity. You don't include reserves. So market value is purely market value. It is only when you are calculating using book value that you add reserve to ordinary share capital. Okay, you also said, are we supposed to ignore it? Of course, you ignore the reserves. Yeah, you ignore the reserves. So reserves is only applicable if you are using book value. You just add ordinary share capital plus reserve, that's all. But if you are using market value, you don't include reserves. And that's what I demonstrated how to calculate market value separately for individuals. Okay. What's the difference? I've already answered that. What's the difference between interest rates and rate of return? Does rate of return means cost of capital? Yes. Rate of return means cost of debt, cost of equity, cost of preference share. Yes. Okay. So let's have a short example. Let me stop sharing this. Going forward, I started firing each and every one of you. Some of you are just quiet. You don't ask questions, and then again, when I ask you to read, you just keep quiet. It's like you are attending the class by proxy. Going forward, I'll be putting fire on your legs. All right. So you have to walk. You have to interact. You have to contribute in the class. Okay. So let me look for a short example, especially the one that involve a book value. Okay. Let's see. This one will take time. Oh. Okay. Let's solve this illustration number 11. That's where we are going to stop. Yes. Who is helping us to read? Some of you have disappeared. No worries. Let me look for who will read for us. For Lucas, right? Let me look for Laura. I'm missing you. Laura, can you help us read? I want to hear your sweet voice. Yeah, thank you.
The account of Austral Plc reveals the following capital structure: 1 naira ordinary share of 2 million naira, reserve 3 million, 10% debenture 1 million, total is 6 million. Market value of the above shares is as follows: ordinary share 3 naira 75 kobo ex dividend, debenture stock 80 naira. estimated to be 20%. The cost of debt is 7.5% after tax. What is the weighted average cost of capital using book value and market value?
Thank you, Laura. Yes, that is the question. When you are given a question like this, the first thing first that you need to do is to go to the requirements. Go and check what the examiner wants you to do. So in this question, you have to calculate weighted average cost of capital, all right, using book value and then market value. So without wasting time, because of we have limited time available, let me switch. But you open to the question at your end. Let me switch. So I would then say this is solution to
I haven't switched yet though.
oh, I'm not sharing. Sorry. Okay. Solution to illustration. What illustration is that? I think that's illustration number 11. Yeah. Illustration 11, page. That's page 47. Okay. So the name of the company is Austral Plc. So examiner is asking us to calculate WACC. I would then say calculating WACC, calculating weighted average cost of capital, denoted as KW. So examiner says we should calculate WACC using book value as well as the market value. All right. So I will go to the question. I will go and check the capital structure of the company. How does the company finances its operation? According to the question, the company finances its operation with ordinary share capital of 2 million naira and then 10% debenture of 1 million naira. Okay, so there's no preference share. So if that is the case, if I want to use formula to calculate my WACC, I will say KW, which is WACC, equal to equity value divided by equity plus debt. There's no preference share. So divided by equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by cost of debt multiplied by 1 minus tax. So this is the formula for calculating WACC where there is no preference share. So according to the question, the first requirement, we are to use book value. Pay attention to this. Number one, using book value. You will recall in my explanation, I said that calculating WACC using book value, you are expected to add together ordinary share capital plus reserves to form the proportion of equity. So in this case, I would then say WACC equal to equity plus reserve, ordinary share capital plus reserve. So according to the question, the ordinary share capital is 2 million, reserves is 3 million. Okay, here is 2 plus 3 million, all right, divided by E plus D, equity plus debt. Value of equity plus value of debt according to the question, total value is 6. So all of this multiplied by cost of equity. Examiner has made life easy for us. The cost of equity given in the question, we are told is 20%. So it has been calculated as 20%. So multiply by 20 plus value of debt the book value of debt is 1 million divided by total value of 6 multiplied by cost of debt. Cost of debt, according to the question, is given as 7.5 after tax. So that cost of debt, there's no need for us to adjust for tax because the 7.5 is already after tax. So I will just say 7.5 multiplied by 7.5%. So I'll bring my calculator. All right, starting from the equity, 5 divided by 6 equal, multiplied by 20 equal, that will give me 16.67. Here is equal to 16.67% plus the other side, 1 divided by 6 equal, multiplied by 7.5, 1.25%. Therefore, WACC is equal to 1.25, okay, equal to 1.25 plus 16.67. That's equal to 17.92. Here is 17.92%. So WACC is approximately 18%. Using book value, WACC is approximately 18%. So if I want to use tabular method, I will still get the same thing. All right, using tabular method, I'll create a column for type. I'll create a column for the book value, okay, book value, proportion, then hash total. Okay, we have equity. We also have debenture, 7% debenture. Is it 7%? Let me confirm. 10%
10%.
debenture. Thank you. 10% debenture. Okay, then now we have total here. Okay, this is alternative solution. So the book value is equal to 5 million shares, sorry, 5 million naira. You know, equity, ordinary share capital is 2 million, reserves is 3 million. So here will be 5 million. Debt debenture is 1 million, total is 6 million. Proportion of equity, that is cost of equity given to us, is 20%. Cost of debt of debenture given to us is 7.5%. Okay, so you multiply 5 multiplied by 0.2 equal, that's 1. Then 1 multiplied by 0.075, all right? 1 multiplied by 0.075. This will give us 0.075. So 1.075 is the total. Okay, so I would then say WACC equal to hash total divided by total value, the total book value, multiplied by 100 over 1. Greenwich, I'm coming back to you. Let me finish this. So hash total is 1.075 divided by 6 multiplied by 100. So when you do this, 1 plus 0.0775 divided by, okay, you've already 17.92. Here
Yes,
is 17.92%. So it's approximately 18%. All right. So WACC is approximately 18%. So whether you use the tabular method or you use formula, you get the same thing. So yes, merchants, talk to me.
Good evening, sir. This is Oge.
Who?
Ogechi.
Okay.
Yes,
Talk
sir.
to me.
Yeah, I just needed it to just review this using the first method. The tabular method looks a bit straightforward and simpler, but I need to understand the first method you use. And the formula has something with tax, but it's like this particular question does not have tax. I want to assume that's why we did not bother ourselves with the last part that is 1 minus tax. Is that correct?
It's already there in the question. The cost of debt given to you, this KD is given as 7.5. Examiner call it in the question, you are given as after tax. So that means they've already adjusted for tax.
Okay, so we only
So
use the tax where it has not been adjusted for in the question.
that means you have to include 1 minus tax.
Okay.
So if tax has not been adjusted, the opportunity we have in this question is that examiner has already given to us the cost of equity and the cost of debt. Ordinarily, you are the one that's supposed to calculate it. So as we proceed in the class, you'll be seeing we are the one that will be calculating the cost of equity, cost of preference, and cost of debt. So examiner will not give to you. Ideally, examiner will not give it to you. All right. So, but in this particular question, examiner gave to you the cost of debt as after tax. So because it's already after tax, there is no need for you to adjust for tax again. Because if you adjust for tax again, that means you are double dipping. You are adjusting for tax twice, which is not supposed to be so. All right. So your first question, I didn't get it clearly. What did you say? You are far. I think you are far away from the speaker. I struggle to get you.
Oh,
Can you
I'm
take?
sorry about that. Is it
Yeah, go ahead.
okay? Um, this particular KW is cost of capital where we have 16.67. I don't know how we arrive with it, but I have 0.16663. So it's really, I don't know if you
See
can help us
now.
to
See, 2 plus 3. 2 plus 3 is
5.
equal to 5. 5 divided by
Uh,
6. 5 divided by 6 will give you 0.88 something, 83 something. So multiply by 20. So it will give you 16.67. Do you get?
I'm actually typing it right now. Oh, okay. You just use 20 direct, not 0.20.
No, you
Okay.
don't do that. If you do, you can see I did not multiply my own with 100% because it's implied. Just remove the percentage. Just say 5 divided by 6 multiplied by 20 plus 1 divided by 6 multiplied by 7.5. You get your answer. All right?
Okay, thank you very much.
You're welcome. So lastly, let's quickly use the market value. Oh, this thing has, okay, let me do it this way. Let's do it this way. I will push this one. KW equal to is approximately 18%. All right, so let's use the market value for the second part. High using market value. Okay. So using market value, the formula will still remain the same, but you need to go and calculate market value of equity and market value of debt. So I will go and do my working somewhere. So I want to calculate market value of equity. Let me write it out in full for you. Calculating market value. Okay. So market value of equity equal to, in this question, are we given number of shares? So we are not given number of shares.
Are
We
not
are given
given.
share capital. So that 2 million naira is share capital. So the nominal value is 1 naira. Therefore, I need to calculate my number of shares based on the information available. So in this case, instead of me to put number of shares multiplied by XD share price, I will use share capital because I'm not given number of shares. So share capital divided by nominal value. Nominal value is the same thing as par value or face value multiplied by XDIV share price. So E equal to the share capital is 2 million naira. Nominal value is 1 naira. That means number of shares is 2 million shares. So multiply by XDIV share price. According to the question, the XDIV share price given to us is 3 naira 75 kobo. It's already ex dividend, so no need to make adjustments. So 3 naira 75 kobo. 2 million divided by 1 naira. So that will give us 2 million shares. So 2 million multiplied by, okay, 2 million multiplied by 3.75.
7.5.
That will give us 7.5 million. Thank you. 7,500,000. Then the value of the debenture, market value of the debenture, will be computed as nominal value multiplied by X int price. X int price divided by 100 naira. Remember, that is quoted at 100 naira per unit. So I will go back to the balance sheets. The nominal value given to us for the debenture is 1 million naira. Okay, the X int price is 80 naira. Debenture stock is 80 naira. So 1 million multiplied by 80 naira divided by 100 naira. So this will give 800,000. So the total market value will be equal to value of equity plus value of debt, which is equal to 7.5 plus 800. This gives us 8,300,000. That's it, 8,300,000. All right, so I can then go back. Now that I've calculated market value of equity and market value of debt, so I will then come here. So using market value. All right, so WACC is computed as equity value using this. We have the same formula. Let me go back there to refer you. This is the formula we are using. I don't need to rewrite it again. Equity value is 7.5. Here is 7,500,000 divided by value of equity and debt, 8.3 million. Multiplied by cost of equity of 20% on one side, plus, open a bracket, market value of the debenture is 800,000 divided by total market value, 8,300,000. Multiplied by cost of the debenture is 7.5 after tax. So no need to adjust for tax. So KW equal, you bring out your calculator where you are, 7.5 divided by 8.3 million. 8.3 million multiplied by 20 equal, this gave us 18.07. 18.07% plus on the right side 800,000 divided by 8,300,000 equal, then multiply by 7.5 equal 0.72 equal to 0.72%. So WACC is equal to 18.07 0.07 plus 0.7, that'll give us 0.79, 18.79%. Yeah. So WACC is approximately 19%. So using market value, WACC is approximately 19%. So if you want to use tabular method, just go, you can practice it on your own using tabular method, the same way we did. Because I was dragging that thing the other time, this has disappeared. Did it move to somewhere else? Let me check. Where is the figures I put here the other time? Anyways, this is type. Okay. This is 10% debenture. Here is a value of equity is 5. Here is 1. Total is 6. Okay. So that's. So you can use this table to get the market value. Okay, to get the market value method. So you are still going to get the same thing as 19%. All right. So this is where we are going to call it a day. Let me hear from you if you have any question for me. Almost 30% of the members of this class have disappeared. It's understandable. Yes, talk to me. Any question for me so that we can close the class? Okay. So in the absence of no further question, this is where we are going to, David, go ahead.
In the tabular method, how do you adjust for tax?
In the tabular method, you are not adjusting for tax in tabular method now. Look at the tabular method I gave to you. Before you arrive at this tabular, you will have adjusted for tax. All right? So there's no need for you, when you are calculating your cost of equity, this cost of this 20%, this 7.5% cost of that, you would have adjusted for your tax. All right?
Yeah, okay.
So when you are calculating your market value, look at when you are calculating your market value, you would have adjusted for tax. Okay? Do you get?
Yes, sir.
So the final answer is what you are putting in the table. You would have adjusted for your tax. So all those KD, is KD multiplied by 1 minus tax. So when you calculate this KD, you would have adjusted for tax. So when you get to the table, just slot in the final numbers there. That's it. Okay? So any other question? All right. So in the absence of no further question, this is where we are going to call it a day. By the grace of God, we are meeting. Who is speaking?
Sir,
Is anybody?
yes, sir, is you, sir.
Okay, talk to me. Talk to
Yes,
me,
sir.
Amara.
The nominal value in 1 naira, is it the 10% debenture?
Nominal value of 1 naira. I didn't get your
Yes, sir.
question. Take it again.
Yes, sir. The nominal value of 1 naira.
What about
Is
it?
it our 10% debenture?
Nominal value of 1 naira is you are mixing it. Nominal value is on equity. Nominal value of 1 naira is equity. When you say nominal value, it is the face value, the amount you have in the balance sheet per share is 1 naira. It's different from the debenture. I told you the debenture is always quoted at 100 naira per unit. So it's not the same thing. So that 1 naira is meant for equity. The par value of the ordinary share is 1 naira. Par value is the same thing as nominal value or book value or face value per share. All right, Amara?
Yes, sir. So are you saying that the nominal value is the 1 naira is just constant?
It's constant, yes. When you look at the question, it's there. In the question, the examiner even calling nominal value. So that 1 naira ordinary share, 2 million. So it means that that 2 million naira is the total book value of the ordinary share capital. So the value per share is 1 naira. So that 1 naira is the nominal value, or you call it a face value or par value of the ordinary share capital. All right. Amara, are you still there?
Yes, sir. Thank you. Yes,
All
yes,
right.
sir. Thank you.
Okay then. So let's call it a day. So in our next class, we are going to have at least two big illustrations in relation to WACC. All right. So if we still have time on that day, I can then introduce you to project-specific WACC. So give and take, we have about minimum of 2 periods to complete cost of capital. All right, that will be lecture day, is it lecture day 4 or 5 next week? But in any case, that's it. Okay, so thank you everyone for participating. I will see you next time by the grace of God. Good night. Bye-bye.
Thank you, sir. Good night.
You're
Thank you,
welcome.
sir. We'll be expecting the notes, sir. Thank you.
No problem. I will share. Yeah.